So what it says is that there's a flight to safety, obviously, and that people were mispricing risk, I think. There was a lot of complacency in the market. We had very tight credit spreads, very low yields on high yield bonds, very high valuations on stocks, and people were caught when this happened, and they've been rushing into treasuries. It also tells us that the market is expecting the Fed to cut rates, just as everyone's asking them to do. So the market is building in a couple of rate cuts, and that's going to work its way through the entire yield curve. Is it sustainable? For a while, sure. Of course. I've been asked since 1986 when the bond bull market is going to end, and I keep saying, not anytime soon. I'll probably be retired.
Every year for the last 10 years, I think we've started the year saying this is the year when we're going to finally see rates rise. And we did it again this year, I think, too. And here we are, 2 months into the year.
Now, will they bounce off of these levels? Sure. It wouldn't be too surprising if things calm down that we get a bit of a bounce. But the problem is now if we morph from, supply shock to demand decline to recession, and what we have to watch is employment, because that's the mainstay of this economy has been job growth and decent consumer spending. If that starts to roll over in response to that, then we have
that brings up an interesting point. Some have said JOLTS suggested we were already getting there, even with the limited data set. Was it just a matter of time before this jobs cycle rolled?
Well, at some point, although we have a very tight labor market, so there wasn't necessarily looking like it in 2020 until this all happened. But yeah, JOLTS, the new job openings have rolled over. We'll have to wait and see jobless claims. If they start to pick up, that would be a sign. But, it wouldn't be surprising after 10 or 11 years that we're going to hit a speed bump that sends us into a recession. So employment's really, for us, that's the key to watch from here.
Do you have a base case as to when we would see the string of monthly increases in employment end?
I don't have a base case yet. I want to see those jobless claims tick up. And then we would start to say, okay, maybe second, third quarter, probably third quarter and beyond, we could see that. The yield curve's telling you it's, recession risk has risen. Credit spreads are telling you recession risk is rising. And that's what we're monitoring right now.
So you mentioned that the market is starting to price in and actually bet on the probability going up of the Federal Reserve cutting interest rates. As the market does that more and more aggressively, we're now talking about a potential 50 basis, a times 2 kind of cut. Isn't the scope for disappointment even more when the Fed does actually act, if they do?
Yeah, I don't think there's going to be a 50 basis point cut, okay, because we haven't had one in, 20 years or something, and that would almost signal panic. And I think they're trying to take a very cool, calm approach, saying this is a supply shock, we can only do so much with monetary policy, blah, blah, blah. We've all heard that from them. But I think that they're going to look at some of these indicators and say, if we get financial conditions really tightening, as they are with credit spreads blowing up, then they're going to say, well, we can mitigate that risk by edging rates lower. But I think they'll take a slow approach. I don't think they're going to come in with shock and awe.
You think they wait to the meeting, or can we get an intra-meeting cut?
I think they wait for the meeting. I don't think they want to signal that they're panicking. I think they just feel that would probably make it worse.
So let's be clear. Credit spreads are not blowing out.
Well, they've gone from extremely low levels back to slightly above normal.
Right.
But they've done it very fast.
I think what's interesting about it, and David and I were talking about it, is that we didn't see that type of reaction when some of the trade war risks, for instance, were happening. There was a lot more complacency in this market over other periods of market risk in the last few years.
Yeah, I think who would have predicted this, right? This is not one of those things that you put into your forecast and say, well, if this happens or if that happens. We knew about the trade war. We knew about some of these other risks. This was a risk that just came out of the blue. And so it wasn't priced in at all.
There's a lot of liquidity in the system, too, isn't there?
There's
not a lack of that at all.
Ample liquidity in the system. But again, if financial conditions start to tighten, we saw this in 2018. Now, there were other things going on. The Fed was raising rates and signaling more rate hikes, so that was a problem. But when you saw financial conditions really tighten in the fourth quarter of 2018, they did pivot and switch to an easier policy, saying if we get to that situation again, a pivot to slightly easier policy is probable. But again, as everyone's been saying, it can only do so much.
Warsh, this morning on our air, suggested that the argument for this cut, which he's made in the op-ed earlier in the week, is stronger than the ones for the last 3. Do you agree with that?
No, I don't think so. We're not at that point in terms of credit conditions, and also the signaling. They have been signaling easier policy for quite some time. The last 3, they had been signaling tighter policy, so they needed to reverse that. This time, they're already on an easing path, so I think this is just an incremental change.
So if I'm in stocks, should I be moving money to bonds, or is it too late?
Well, we always advocate people have an strategic asset allocation that's consistent with their risk capacity and their risk tolerance. And if you find that you're really nervous right now, it means you didn't have the right allocation. So, I talk to a lot of investors who say they don't want to buy bonds because yields are too low. I tell them that's not the only reason you buy bonds. You buy them for times like this because they provide the best diversification from stocks. So if you're uncomfortable with where you are, then you need to probably think about making some changes.